This is the weekly economic and market update for the week ending uh, June 17th and looking forward to June 20th. And the three sections that I'm putting this into are my current sentiment about the economy and the market. The second is economic and market indicators that kind of popped out this week. And the third part is just kind of a commentary on things that I'm doing personally. So let's start with the sentiment. I've been, for the first two episodes that I did on the weekly update, still bullish on the market, 65% bearish, 35% long term. I am still 100% bearish. So my expectation still is that things are going to fall apart at some point. I just don't necessarily believe that it's now. But I tell you, I went through some gyrations this week with sentiment, and mostly because of what was happening with the 10-year Treasury, where we had a spike up just short, I mean, really just short of 3.5%. If it would have continued on up, then I would have really gone down from even 50-50 bearish. And at some point this week, I was just about there. But I'm somewhere in that vicinity, above 50%. Um, Bullish, bearish, 0% neutral, and 65-35. But I'm probably not as optimistic, even though I still think we'll at least get a bear market rally. And some are calling for, one person actually calling for a melt up, maybe a bear market rally that goes crazy, because this person believes we're at the end of a cycle. His name is David Hunter. He's all over Twitter. And I think I'll do an episode on his predictions because I think they're interesting, and he has been right eventually, kind of like Peter Schiff. And so it's someone I follow, and he is a real contrarian in the marketplace. So that's my current sentiment. Let's go through some of these economic indicators. Let's start with the AAII Investor Sentiment Survey, and as you can see, as of Wednesday, people were 19.4% bullish and 58.3% bearish and 22.2%. So that's what other people are, other than myself. Um, for me, this is a very contrarian indicator that I watch. It's not the only thing I watch, but it's certainly one of the things that I pay attention to, because when people get super bearish, I want to be bullish, and that's why I haven't really fallen out of the, below the 50%, and paid a price. But there are things that you can do that I'll mention at the end of this update. The second thing that came out this week that got my attention was the GDP estimate, gross domestic product estimate for the second quarter. Now it's been, people are expecting it to be 2 point, or excuse me, but positive in some degree, but it has been ratcheted down from, I think, around 1.5% down to zero now. And if it goes below zero, which I think is possible, if not likely, what that means is that we'll have had 2 quarters in a row of negative growth, which is the operational definition of a recession. So last quarter was revised down, actually, to 1.5%, a negative GDP. And I think that when they announce it, they may try to keep it at zero, um, but I think the reality is once it gets revised again, of a month or two later, that it'll get revised into the negative, and that we are actually in a recession. Um, Now, you know, GDP and being in a recession will help alleviate some things like inflation, because one of the things that you will see is let me cover that actually right now. We'll go run over and look at the WTI chart, and you can see that we had oops, wrong one, which is the West Texas Intermediate crude. It's topped out, and actually this has been a good investment for one of my plays. But when it was up high up here around 120, 121, I started thinking it got a little bit frothy, and basically put in a bear puts back spread, and now we can see that it's dropped quite a bit to under 110, 107.9, and that should provide some relief on things like inflation in the short term. Long term, I think it's going to get ugly next year through the end of the decade. $250, $300 a barrel oil or more. And I hope I'm wrong. So that's the West Texas Intermediate, and it's going to provide some relief at the pump at some point. It's not immediate, but relatively short term. The U.S. Treasuries, which is something that I paid attention to and I mentioned in the sentiment part of this report, got up to 3.49%. Right now it stands at about 3.33%, which is still kind of in my yellow area. I'm not, it makes me a little nervous that it's that high, but it helps with the tightening. If it got over 3.5%, then I'm either in cash or shorting the market in some fashion with options or something else. So, but right now it's backed off again, and the 10-year Treasury to me affects so many different things. Your ability to borrow, whether it's home equity loans or whatever. I guess you could say the 2-year and the 10-year, but I kind of narrow in on the 2-year. And when it goes up, you can see even the mortgage rates are for a 30-year 5.78%. You don't want adjustable rate mortgages right now or ever, especially now, because when they'll ratchet up after 1 year to percentages that you may not be able to pay. So the 10-year is something that I really pay attention to. Let's look at how that affects things like housing starts. We can see over a longer period of time. We've been in an uptrend for a while. We're still in that uptrend, but we're starting to back off the number of housing starts. And as mortgage rates go up, people are used to 3%. Now, people my age will know that we were happy with 8-9% back when we bought our first home. And those were something that were offered by the home builders themselves, and so you were able to get a halfway decent deal. But people would freak out today if they had to do 9%. They're going from 3 to, let's say, 5.78% of it running now. Really, it increases the cost of things. I mean, it's inflationary in nature. So that's the kind of tie-in between the 10-year mortgage rates and something like housing starts. There's other things that I could have shown, but we can start to see that the housing starts are starting to go down. I don't think it's necessarily broken the trend yet, but I think it will. Um, then we also look at the dollar, which I thought the dollar was going to start rolling over after yesterday, which was Thursday, the 16th. And today it bounced back. As a matter of fact, it came close to coming to very close. I don't know whether I made it or not. Let's see what it says. Yeah, I made it just past 105 dollars on the DXY, and I'm expecting this thing to start really rolling over at this point, or at some point in the short term, and continue its way down. And we all know I don't really want to cover this too much, but if we look at, this is an ugly chart. I mean, we've only had one up week over the past, 3, 4, 5, 6, 7, 10, 11 weeks. Now, these things have a tendency, as I found on these candlestick charts, to level off over time. In other words, if you get 11, 1 and 11, you're probably going to wind up at least getting 9 of 11, or eventually those candles red versus green, which are up, and red, obviously down days or weeks, level off. It's actually kind of a bizarre thing that I discovered, which is that they are a distribution, a normal distribution. When you look at almost any stock or any ETF, at the end of the year, if you look at 100 different candlesticks like these, that approximately 50 are going to be red and 50 are going to be green once you get down to the end and start doing the counting. And it doesn't mean that you can't get it out of whack, which obviously it's done, but my expectation is going to be that we're going to start to see at least a bear market rally here, in the relative short term. I'm going to say in the next week or two. Now, whether that turns into a melt up like David Hunter's predicting, I don't know. It could, but that's why I'm making different plays, which I'll talk about at this juncture. Now, the things that I'm doing today are to kind of protect myself on either the down or the upside. So, for instance, I've been looking at, I did a bear put spread, which actually I have a video on that you can watch under my playlists for option strategies. That if if my expectation is that we're still going to go down some more, then I do like an energy with oil. Do I think that's going to keep going down? Probably. That's my expectation. But if I'm wrong, and I'll self-admit I'm directionally challenged, and it pops the other way, and let's say spikes up, I don't know, China invades Taiwan or something crazy, then it's got me protected on the upside, but my expectation is I'm playing the downside and I can profit greatly from a downside run like that. On the reverse, if I am expecting a bear rally here in the next week or two, I've made a few plays by doing a bull callback spread, which again is in my option strategy playlist, and it's going to protect me if it doesn't pan out and does go lower. I can still get a little bit of profit from that depending on how I set it up. And if it goes up, I kind of have unlimited profit potential and limited risk. And I like those plays at these kind of crazy times. You can also use a straddle where you have on each side unlimited profit potential and limited risk with regards to the amount that you're paying for that straddle. Again, in my option strategy playlist. The other things that I'll mention for this week is food. I've mentioned this many times for people who follow me on Facebook, and these are friends, people that I've known over the years, that the food supply is going to be in jeopardy. Now, it shouldn't affect the U.S. as much as others, but hey, who thought baby formula would be, uh, you know, something that we would run out of? And the stores during the pandemic. My suggestion is, each time you go to the grocery store, pick up 3 or 4 cans of something: beans, canned beans, or dried beans, or canned chicken, or whatever it is, and just keep it. I even got Spam, um, and I haven't eaten that in years. But if I had to, and that was the only thing available, I would. And so do yourself a favor, stock up, put a couple extra cans in your grocery cart, or more, and because if there is a food shortage, uh, this is where things I think will get ugly. Not necessarily this year, but in the uh, if I'm to forecast something, and I've been forecasting my Facebook page for a while, in association with kind of the Austrian economic folks, which is that we're going to see an 80 to 90% crash in the market ultimately. I'm hoping this isn't it yet, that we still have one more, at least bear market rally. But read the book Crash Proof by Peter Schiff. If you want to learn more of kind of an Austrian economic type of view on things, and you'll learn quite a bit about something other than what I was taught was Keynesian economics when I was in college. That you got to have the government intervene because um, somebody's got to do something when things go wrong. So I just um, you know free markets, and the closer we get to that, the better we are. But for whatever reason, mankind believes that we can control things, and when you have so many different factors at work in an economy, especially a world economy, you can't control things. And the more you try, the more you wind up, and another episode I need to do on tampering, you wind up tampering and making things worse. And that's exactly what's happened with the way that our politicians have spent money, with our 30 trillion in deficit. And you got to pay the piper at some point, and we're going to pay. And spending more money is just an insane proposition. We should not be doing that, anymore. There's Build Back Better. Thank you, Joe Manchin, for killing that thing. There are people out there with a modern monetary theory that believe that if you spend more, that it won't matter. Well, start with me. Just go ahead and give me $10 million, and give everybody $10 million, and we'll see what happens. But anyway, I'd be available to buy a few things before that time period. Okay, well, that's it for this weekly report. Thanks for listening, and remember, there is always a better way.